So you've already decided that you want to own Fidelity index funds, and you've decided you want to own a single Fidelity index fund that covers the vast majority of the stock market, or perhaps even the entire stock market. But then you're thinking to yourself, should I own the Fidelity S&P 500 index fund? Should I own the Fidelity Total Stock Market Index Fund? Or perhaps the Fidelity Nasdaq Composite Index Fund? In this video, I promise to give you the most comprehensive analysis of these three individual Fidelity index funds. We're going to look at how they've performed, their minimum cost to invest, their expense ratios, their composition, but even on a deeper level than you can see on Fidelity's website. And we're also going to look at what actually would have happened if you had invested in these three individual Fidelity index funds over the past 10 years, and furthermore, what would hypothetically happen in the next 10 years as well. I'm ready. Are you ready? Let's go. Hey guys, before we get started, make sure to hit that subscribe button below the video to ensure you do not miss any future videos I post. Make sure to leave a comment below saying you subscribed, and I promise to respond personally to your comment. Alright guys, let's go ahead and jump right into the content. You know I never like to waste a moment of your time. In this video, we're talking about three different index funds. We're going to start with just a quick overview of each of the index funds. So first we have the Fidelity 500 Index Fund, FXAIX. This fund invests at least 80% of its assets and common stocks included in the S&P 500, which broadly represents the performance of common stocks publicly traded in the United States, specifically the top 500 companies in the United States. Next, we have the Fidelity Total Market Index Fund. Ticker symbol is FSKAX. This fund invests at least 80% of its assets in common stocks included in the Dow Jones US Total Stock Market Index, which represents the performance of a broad range, really the entire stock market, both large cap stocks, mid cap stocks, and small cap stocks. And then lastly, we have the Fidelity Nasdaq Composite Index Fund, FNCMX. And I have to apologize, in the last Fidelity video I made, I talked about 6 index fund strategies, and I mentioned that the Fidelity Nasdaq Composite was only an ETF, but I was wrong. There is actually an index fund as well, which is what we are profiling in this video. This fund seeks to provide investment returns that closely correspond to the price and yield performance of the Nasdaq Composite Index. Now, one thing I want to make sure you understand right away is that the Nasdaq Composite Index and the S&P 500 have overlap despite being different indexes. So companies like Apple and Google and Microsoft are in both of the indexes. And the same goes for the Total Market Index as well. Since it covers the entire stock market, you're going to see a lot of overlap between these three indexes. But there are some significant differences which we are going to talk about. If we take a look at the expense ratios, which we need to understand, all index funds are going to have expense ratios because there is a cost involved for Fidelity or Vanguard or whoever is running the index fund to manage the fund, to buy and sell securities, to pay for their own salaries and everything in between. Index funds are going to have a lower expense ratio than actively traded mutual funds, but there's still going to be a fee. If we look here at the Fidelity 500 Index Fund, you can see the expense ratio is 0.015%. And just to give you some perspective here, if you were to say have, let's say $50,000 invested, and the expense ratio is charged on an annual basis, you multiply that by 0.015%, means every year it charges you $7.50. That is extremely low, and that's gonna be the same amount for the Fidelity Total Market Index Fund as well. They have both of the same expense ratio, 0.015%. The Fidelity Nasdaq Composite Index Fund has a higher expense ratio. The net expense ratio is 0.29%, as you can see right here. And so that changes how much is charged on an annual basis. If we take that same $50,000 and multiply it by 0.29%, that means the fee is actually $145. So $7.50 for the two index funds, and then for the Nasdaq Composite, $145. And that fee is charged on an annual basis. But we can't take any single one of these facts out of context. We have to look at the whole. And the results we're going to look at, the performance is what's going to matter, because the performance we look at incorporates these expense ratios into the final results. In a moment, we're going to take a look at the actual stocks that are in each of one of these indexes. But first, let's take a look at the market sectors. So you can see that both the S&P 500 and the total market have very similar weightings. The S&P 500 has 27% in the information technology sector, then 13, 12, 10, and 10 in healthcare, consumer discretionary, communication, and financials. Very similar as well for the total market. But we're going to see a significant difference with the Fidelity Nasdaq Composite. You'll see here that 42% of the assets are in the information technology sector. And then we've got 17% in consumer discretionary, 16% in communication, and then 10% in healthcare, with very few holdings in financials, consumer staples, industrials, and real estate. Now, we could take a look at the top 10 holdings on the website, but let's go a little bit deeper into my Microsoft Excel spreadsheet, which, by the way, you'll be able to access this if you join my Patreon community. All of the spreadsheets that I create, mostly for dividend stocks so far, but I'm also making them for my investing videos that I make as a whole. If you want access to these spreadsheets, you can join my Patreon community for as little as $5 every month. That will give you access to my portfolio, as well as every single dividend spreadsheet I've made so far, all of the investing spreadsheets I've made so far, and any future ones I make as well. If you're interested in that, then click on the link in the description below. All right, let's move on. All right, let's take a look at the weighting by the top 25 stocks in each of these index funds. So first off, let's take a look here at the S&P 500 FXAIX. You'll see here, and this is actually going to be very similar to what we see in the total market, but let's start with the S&P 500. S&P 500, we have 6% in Apple, 5% in Microsoft, 4% in Amazon, and then 2, 1, 1, 1, 1, 1, all the way down here with Facebook, Alphabet, Class A, and Class C, which is Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and so on and so forth. And you can see how this charts out. We have a total of 500 different stocks in the S&P 500. The top 25 holdings get 39.78% of the assets, and then the remaining 475 stocks only get 60% total. You can see that right here, the difference between these holdings here and the remaining 475. This is what's known as a market capitalization weighted index fund, and all three of these are going to be market capitalization weighted. What that means is, if you're not familiar with that term, the top holdings based on market capitalization, how much value are in these companies, they're stack ranked based on that. So the most valuable companies like Apple, Microsoft, Google, Facebook, Amazon, they're going to get a much more significant weighting in the index than smaller companies, the really small ones. And you're seeing that on display here in this graph. So yes, you do get a lot of diversification with these funds, but not quite as much as you thought. They're not equally weighted. You get more weighting in the bigger companies. Next up, we have the Total Market Fund, FSKAX, and it's very similar to the S&P 500, but not quite as much money as in the top 25 holdings. The top 25 holdings do get 33% of the index, which leaves only 67% for the remaining 3,507 holdings in this index fund. So yes, it's diversified. You have 3,532 holdings, but the remaining 3,507 after the top 25 only get 67% of the weighting. And then lastly, we have the Nasdaq Composite Index Fund, FNCMX. And right off the bat, you can see a significant difference from the other two index funds. You clearly have a much more significant weighting in the top holdings for the Nasdaq Composite Fund. You've got 2,485 stocks in this index, and the top 25 holdings make up 57% of the index. You can see here Apple at 11%, Microsoft at 9%, Amazon at 8%, Facebook at 4%, and the remaining 2,461 holdings only get 43% of the index. So it's definitely top heavy with these top 25 holdings. So let's have a conversation about how these funds have performed. Now, we could just have a very brief overview, like I've actually done in the past, and just look at the numbers here on the website. But I think there's an opportunity to go even deeper here with our analysis and take a look at the actual price history back from 2011. Unfortunately, we couldn't go back farther than that because that's the one of the three funds that's as far back as Yahoo Finance would go for the price history. But we can look and see if we contributed money on a monthly basis and we reinvested dividends, how would these funds have performed in the previous 10 years from 2011 through January of 2021, and then we can make some hypothetical assumptions about what would happen over the next 10 years and see which one performs the best. All right, so we're back here in my Excel spreadsheet, which again will be available to you guys through the Patreon community, and we're going to take a look here between these three different funds, which one performs the best from 2011 to present, using the actual price history of these funds. So here are our assumptions. We are going to reinvest all dividends, and you should know that dividends are paid out differently with these funds. The Nasdaq Index Fund pays an annual dividend every December, whereas the Total Market Index Fund pays twice a year in April and December, and then the Fidelity S&P 500 pays a quarterly dividend, which is what you've come to expect from most stocks. We're going to assume that all dividends are reinvested as opposed to taking them out as cash and investing somewhere else. We're going to see how each one of these funds would have compared if we had made a $400 per month contribution in the beginning to each one of these funds. We're assuming that we would only own one of these funds, so we would allocate the $400 per month to one of these funds. But for the sake of the example, we're going to do $400 per month to each one of these funds to see how they would have performed equally. And then every year we're going to increase our contribution by 3%. I do think that for the average Joe out there, $400 per month for somebody who's actively trying to invest for their future is very reasonable. And it's also reasonable that you would get a raise every year and that you'd be able to contribute an extra 3%. So those are going to be our assumptions for the analysis from 2011 to present, January 2021. And then what we're going to do is see how these funds would have compared for another 10 years, making some hypothetical assumptions. So we're going to include from 2011 to hypothetical 2031. We're still going to assume, you can look at our assumptions right here, reinvesting all dividends, a $400 a month contribution from 2011 and increasing it 3% every year. We're going to assume dividend growth rates based on what happened in 2011 through 2021. We will take an average of the dividend growth year over year and apply that for those 10 years for hypothetical assumptions. And then the price history, we're going to assume, since we don't know what's going to happen from 2021 through 2031, we took an actual price history and then averaged it. For the S&P 500 and the total stock market, we took a look at the S&P 500 monthly average since 1986, and we applied that average to those 10 years. And just for your awareness, that price increase was 0.80% every month increase. We applied that to both the S&P 500 and the total stock market. And then for the Nasdaq Composite Index, we were able to go back as far as 1998 to the actual index, and we took an average of the monthly price changes every month since 1998, and that resulted in an average monthly increase of 0.0095 or 0.95%. Okay, so what actually happened during those 10 years? Well, we know that for those 10 years that things were kind of crazy. We had significant price increases. We had essentially a 10-year bull market. So it's not necessarily representative of what would happen over 20, 30, or 40 years, but we're starting with an actual historical look at what actually happened and what would have actually happened if we'd invested $400 a month and increased it by 3% every single year. And here's what would have happened. Based on those assumptions, the total stock market would have a total holding value of $97,537.04, and we would own 908 shares of that index fund. The S&P 500 would have 746 shares and be worth $96,125.25, and the Nasdaq Composite Index would be worth $129,280.01. Again, things were kind of crazy for the past 10 years, and we know that we had a bull market. And furthermore, we know that that bull market was driven by a specific set of bulls, the information technology sector primarily. Companies like Apple, Microsoft, Amazon, Google, etc. So we know that the Nasdaq Composite Index was going to outperform during these 10 years. And here's what would have actually happened based on those assumptions. But I guess the big question would be is how does this hold up based on our hypothetical scenario from 2021 through 2031 and incorporating those previous 10 years from 2011 to present and those hypothetical years? Let's take a look at what would have actually happened. Like I mentioned here, we used the actual monthly price history from 2011 through 2021, and then we made some assumptions for 2021 through 2031. So as you can see here, this took a little while to build. If you find some value out of it, if you appreciate the effort that I put into this, then make sure to hit that like button, and make sure if you haven't done it yet, hit that subscribe button as well. Okay, based on that assumption, here's what would have happened. The total stock market, you would own 1,622 shares, and the holding value would be $498,801.68. The S&P 500 index would be worth $503,000, probably due to the fact that the dividends were invested quarterly and then reinvested. You'd own 1,364 shares of that index fund. And then the Nasdaq Composite still outperformed here. 1,172 shares, and the holding value $669,839.04. So based on all of this analysis, guys, it does look like the Nasdaq Composite did outperform during 10 years. But again, I want to remind you, all three of these funds did really well. And furthermore, remember that the past 10 years are not representative of what would have happened in the future or any other 10-year period. Never before has information technology outperformed the way that it did during this 10-year period. And it's unlikely that Apple and Tesla and Google and Amazon are going to perform just as well in the future as they did during these past 10 years, which happened again after that crazy financial crisis that we had in 2008, 2009. So food for thought here. Remember that these funds do overlap quite a bit. A lot of the top holdings are the same: Apple, Microsoft, Google, Amazon, Tesla, etc. So you wouldn't want to hold all three in the same portfolio because of the overlap. So based on what we looked at here, you're probably just gonna have to pick the one that you feel most comfortable with and how it's going to perform in the future. One thing I will mention as well, since I do talk a lot about dividend stocks here, is that based on the most recent 12 months, the index fund that was throwing off the most dividend income every single year happened to be the S&P 500, which was throwing off about $12,364.63. The Nasdaq Composite was worst. It was only throwing off $8,859.67. And the total stock market came in second at $9,575.11. Hopefully you found a lot of value out of this video, guys, and you learned enough information so you can make an informed decision on which one you want to own in your own portfolio. So make sure to leave your 2 cents in the comments below. Which one of these funds do you own now? Which one are you going to own based on this analysis? And of course, please make sure and leave a comment below and let me know which videos you want to see more of in the future. I'm always open to your guys' feedback. That's all I've got for you guys in this video. Make sure to hit that like button, hit that subscribe button if you haven't done it yet to make sure you don't miss any future videos. And have a great rest of your day, guys. Please continue to stay healthy, both physically and financially. Have a good one.